Hello all, this is John Kogan. I'm the CEO of Proformative, the online community for corporate finance, accounting, treasury, and related professionals. I'd like to welcome everyone to today's webinar entitled Leveraging Analytics to Manage the Cost of Debit and Credit Card Payments. The cost of processing credit and debit card payments has been increasing over the last decade. What are the long-term implications and strategies for companies to effectively manage their electronic payment acceptance costs as customers increasingly demand multiple vehicles to remit electronic payments? Today's webinar will include a discussion around the impact that we just discussed, as well as that of the Durbin Amendment in the arena of card processing costs, and also provide an outline of a control framework so that attendees may understand and implement a strategy to reduce the cost of credit and debit card payments. We have a number of quick notes to go through before we get to the content itself. Number one, the format today is a 60-minute webinar. We will have a presentation first, followed by a Q&A period, so you will have time to ask questions. A few quick notes about Proformative. For those who are new to Proformative, we're the largest and fastest growing online resource for corporate finance, treasury, accounting, and related professionals. It's a completely noise-free site based on peer-to-peer conversations with great valuable information. We welcome you to check it out, and conversations just like the one we'll be having today can be found amongst your peers on Proformative. A few notes about today's event. Links to today's presentation and to the recording of this webinar will be sent out to all attendees within 24 hours of this event. The presentation itself is actually already posted at proformative.com/resources. So if you want to go and grab it and download it, print it out, whatever you like to do, it's right there at www.proformative.com/resources, free download. You can grab it, follow along, or send it out to your friends, whatever you like. Next up, we are providing CPE credits for today's event. In order to get those CPE credits, you will need to answer all 3 of the polling questions during the event. We have 2 of them spread out during the presentation itself, and then 1 at the very back end of today's event. You should have also pre-registered for CPE. If you have any questions at all about that, please contact Chris Brower, and you can see her email address right there. We would like this to be an interactive event today, so please do ask questions on today's topic. If you'll take just a moment to glance at your GoToWebinar control panel, you'll see there's a questions box. We'd like you to use that liberally. If you have any questions about what's going on, any questions for the presenter, please feel free to use that interface, and if there are sort of tactical questions as we go, we'll answer them in the background, but questions on the topic itself we'll save for the Q&A period, which will probably be about the last 10 to 15 minutes of today's hour. Finally, you will be asked to take a short survey today regarding the webinar. We love to get your feedback. We always like to do better the next time, as we say. And also, during that short survey, if you'd like to be connected with today's speaker, who I will introduce shortly, that's a great place to do it. With a click of a mouse, you can just request that connection, and we're very happy to connect you. We have a number of learning objectives we'd like to accomplish today. After participating in this event, we'd like you to be able to define the implications of the Durbin Amendment on card processing costs, define and certainly know more about the components and drivers of processing costs, and then provide a framework and some strategy to help you manage those payment acceptance costs. So that's a lot to do in our 60 minutes. And without further ado, I'd like to introduce you to the person who's going to be helping us get there, and that is Anand Goyal. Anand is the CEO of Optimized Payments Consulting. Anand founded Optimized Payments in 2007. He's an expert in the electronic payments industry and has deep understanding of pricing and interchange dynamics and best practices for credit and debit cards, PIN debit cards, private label and co-brand cards, and convenience fees. Anand has shared his payment insights at merchant conferences and publications, including the Merchant Risk Council, Association for Financial Professionals, Atlanta Business Chronicle, Atlanta Business Radio, Vistage, and Proformative. Prior to Optimized Payments Consulting, Mr. Goyal headed the pricing team for Elevon, the 3rd largest payment processor in the United States. So with that, Anand, welcome, and thanks for joining us today.
Thank you very much, John, and good afternoon, everyone. As John mentioned, we have a lot of information to share with you, and my personal goal for the presentation today is for you to walk away with at least one actionable nugget of information that you can use within your organization. So let's get started. The objective of today's call, we're going to be talking about electronic payments, is specifically to understand the impact of the Durbin Amendment and learn of a framework, a 5-step framework that you can use to better understand and manage the cost of card payments. So I'm going to give you a one-page overview of optimized payments consulting, talk about interchange, discuss the Durbin impact on debit cards, and then how you can use analytics within your own organization with some simple tools to simplify interchange. And we'll discuss a 5-step process, followed by Q&A. And as John mentioned, if during the presentation, if anything is not clear or you want something to be elaborated on, make sure you put in your questions so we can address them at the end of the presentation. John, I'm going to turn it over to you for our first polling question.
Yep, so that was quick. We're going to jump right into our first polling question, which I'm launching right now. And you should see momentarily, so what is the biggest challenge or challenges when it comes to managing your card payments? And you'll see the selections there. I'll leave this out for about 30 seconds. Now, if we have time, we'll actually turn this around and allow Anand some time to comment on this during the Q&A. So I would love everyone to participate, even if you're not here for CPE credit. Feel free to jump on in. The results, by the way, are anonymized, so no one on the webinar will see what your response is. I'll leave that out for another 5 seconds or so, and then we'll get right back into it here. Okay, I'll close that down. We'll go ahead and get back to Anand, please.
Great, thank you. So quick summary of who we are. We started our firm about 5.5 years ago. We're based in Atlanta, and our team is consistent of pros from the payments industry. And what we do is offer consulting services to merchants to really help them understand and lower the cost of electronic payments. Unlike many companies in the industry, we don't sell card processing services. We're purely consultants, and we work with a lot of Fortune 1000 companies representing, retail, internet, B2B, healthcare, and telecom sectors. So let's dive into the presentation. When folks in Treasury want to get a handle on the cost of card payments, one of the terms that you're going to hear very often is interchange. And interchange makes up the majority of the cost of card payments. So it's really important for us to define it and have a uniform understanding of what it is. Interchange is defined as the wholesale price charged by the card networks, Visa, MasterCard, and Discover, for settling a credit or a debit card transaction. All the interchange that you as merchants pay go to the bank that issued that specific card. So for example, if you use a Citibank Visa credit card at a Macy's department store and you charge $100, the interchange cost, the interchange rate of, let's say, CPS retail, which equates to $1.61 on a $100 transaction, goes to Citibank because they issued the credit card. You can find the latest interchange tables on Visa and MasterCard's websites. If you want a Discover interchange table, Discover doesn't publish it on their website, but you can get it through your acquire or your ISO. For issuers, issuing banks, interchange represents a significant amount of revenue, and it pays for the cost of money, because when you use a credit card, you're borrowing funds today, and if you pay it when you get your statement within the allotted 3 to 4 weeks, you pay 0 interest. So basically the bank is giving you an interest-free loan, and interchange pays for the cost of money. Secondly, it pays for rewards programs. A lot of us use cards because we get miles, points, and those that value is paid out of the revenue that they collect from Interchange. And Interchange also pays for internal costs, including fraud, and Interchange represents a significant amount of profit for a lot of card issuers. So that's Interchange. So one of the questions that we get asked very often is when you do go download a Visa, MasterCard interchange table, is why are there so many interchange rates? So if you combine the three networks together, you're going to find there are over 700 interchange categories. And you know, they have proliferated over the years, and there are a lot of macro market considerations and micro merchant-specific considerations that have arisen to so many interchange rates. So let me touch on a few. The big market considerations are there's competition amongst the card networks. So Visa and MasterCard, they're always trying to get banks to issue their branded cards. So in that competition, they're always creating new rates or increasing rates, so banks will issue their cards that have higher rates. So it's kind of perverse competition. Instead of that competition driving down pricing, that competition actually causes interchange rates to go up, as they have over the last couple of decades. So there are also card network and issuer strategies as the card networks try to go after new verticals. So you can kind of think about over the last decade, Visa and MasterCard have made attempts to go after small ticket transactions or government transactions or, you know, emerging markets like education and telecom. In order to get new industries, verticals to accept card acceptance, they offer lower, you know, attractive rates. So that causes new rates to be built out. And also, you know, emerging technologies like EMV and mobile, which will cause, you know, additional set of rates to be coming out in the marketplace. And then there's also legislation, the most recent one being the Durbin Amendment, which took effect October of 2010, which caused the regulated debit interchange rates to be set at 5 basis points and 21 cents. And then so that created a new set of interchange rates. And then you have unregulated, the old debit interchange rates. So legislation plays part there. So those are some of the macro considerations. And then you can get into some micro considerations which cause interchange rates to proliferate, like what industry are merchants in. There's a set of interchange rates for, specific to airlines, restaurants, T&E merchants, business-to-business merchants, regular retailers, e-commerce sites. So the type of merchant does matter, and the type of card also. Just because it's a Visa card, all Visa cards are not the same. So you could have a Visa traditional card, rewards card, signature card, debit card, corporate card. So the type of card makes a difference, and then obviously the method of entry. Was a card swiped or keyed? Key transactions typically have a higher interchange rate than swiped cards because they carry more risk. And the last consideration is risk and adherence to compliance standards. So those are things like authorization versus settlement timing. If you're a retailer, you have, till the end of the day to settle all of your transactions that were authorized that day. If you delay for a day or two, you will pay higher interchange fees. And then your authorization amounts have to match your settlement amounts, with the exception of certain industries where you have tips. But outside of those industries, the auth amount and the settlement amount have to match. If they don't, you end up paying higher fees. And then you have address verification schemes that Visa uses for keyed or card not present transactions. And then commercial card elements like level 2 and level 3 for business cards. Of all of the macro and micro considerations that you as a merchant understand, you don't really have a lot of control over any of these in terms of influencing interchange, with the exception of this last category, risk and adherence to compliance standards. this is an area where you can optimize, understand and optimize your internal processes to make sure that you're getting the best interchange rate available for any given transaction. So now let's jump right into, we talked about macro considerations, and one of them was the Durbin Amendment. Let's elaborate on that a little bit. The Durbin Amendment imposed a cap on debit interchange fees for cards that are issued by regulated financial institutions. When I say regulated, it is any bank that has global assets over $10 billion. So basically, the small community banks were saying, you know, it's going to do detrimental harm to us if we also have these caps imposed on us. So what the legislation came up with is a two-tier structure that said all the big banks have to comply to the Durbin Amendment and to our caps, and the small banks do not. So you have two tiers, set of tiers for debit rates. And for all the big banks, they have to comply to the caps, which are 5 basis points plus 21 cents per transaction, and that you can add an additional penny if the issuing bank implements certain fraud procedures. So it's typically 5 basis points and 22 cents a transaction. Since this legislation was implemented on October 1 of 2011, the Durbin Amendment has saved merchants approximately $8 billion in interchange fees, according to a Fed study that was released a couple of months ago. And most merchants in the U.S. have benefited from debit fee caps, but not everybody. So let me give you some very specific examples that we have pulled out from some of the companies that we worked with. So we worked with a retailer where they had about 340 million in card sales. This was their average ticket. Before the Durbin Amendment, their cost for a debit transaction was 59 cents. After the Durbin Amendment, it was 24 cents. And so they saved, on average, 35 cents a transaction. On an annual basis, they saved 1.3 million bucks. So they were thrilled. The Durbin Amendment was great for them, as it was for an e-commerce merchant and a B2B merchant. They're given their size, they saved quite a bit on a per transaction basis and on an annual basis in debit processing, debit interchange fees. However, not every merchant benefited, and a group of merchants that have small tickets. So I'm defining small tickets, less than, let's say, $10. The merchants who had small tickets less than $10, their interchange fees actually went up. And the reason for that is Durbin Amendment says that all merchants are subject, basically the card networks have to come out with interchange rates with a cap of 5 basis points and 22 cents. So they imposed a cap. Well, what did all the issuers do in the card networks? They came out with interchange categories exactly at that cap, 5 basis points and 22 cents. Previously, some industries, like in parking, they had small ticket rates that were significantly lower than the Durbin rates. So for them, Durbin actually represented an increase in cost. So a parking client who did 60 million in card sales, their fees actually went up by 1.4 million bucks. And that is the case with quick service restaurants as well. So a lot of the fast food restaurants, their costs went up because their ticket sizes are small. And you saw Redbox, the kiosk where you can rent movies for $1. Well, a lot of people use debit cards to pay for their dollar rentals, but when the Durbin Amendment went into effect, it increased their cost of card processing, and they increased their rental rate from $1 to $1.20. And they attributed that primarily to the Durbin Amendment. So you're sitting out there, you're thinking, well, how can I, as an individual in an organization, how can I maximize the value of the Durbin Amendment for my organization? So let me give you some insights here. So first, nationally, when you look at the percentage of debit transactions that are regulated versus unregulated, nationally we have found that regulated transactions are about 70%, and unregulated transactions are about 30%. And in specific markets, like if you have a metropolitan market, which is dominated by a lot of large banks, then you can see that mix be skewed heavily towards the regulated side. Or conversely, if you're in a small town where you have a lot of credit unions and community banks, you will find a greater percentage of unregulated debit card transactions. So how can you maximize the value that the Durbin Amendment may provide? One is you want to make sure that you have interchange pass-through pricing. And if you're a merchant and if you have bundled pricing or tiered pricing, you're not going to get any benefit from the Durbin Amendment because your processor is getting all the benefits. They're keeping all the savings for themselves, and they're not passing on to you. And you can recognize those savings by making sure that you are on interchange pass-through pricing. Second thing is you can promote debit. If you're a retailer with signage, if you're an e-commerce site, with logos and prominent displays on your checkout site. And you can also evaluate incentives to drive customers to pay with debit for less costly payment tenders. So here I've listed some examples of merchants that do offer incentives when customers pay them with less costly payment tenders. Blue Nile offers a 1.5% discount from bank wires. IKEA has a pretty clever program where they give you a 1% discount coupon. So if you buy $100 worth of goods and you use a debit card, they'll give you a $1 coupon that you can use on a future purchase. And different merchants offer, different sort of incentives. I think the key there would be to see if you don't have a lot of debit usage, then a program might make sense for you because you're not cannibalizing, you're not getting discounts to customers who are already paying you with debit. So if most of your customers are paying you with credit cards and you know what that cost is, maybe if your cost for credit cards is 3%, it may be worthwhile to think about a 1.5% discount if they pay by debit. And then if you are an emerging market like government, telecom, insurance, utilities, you may want to evaluate pinless debit. A pinless debit it's basically a card going over an EFT network like a Pulse, NICE, Star, without having to enter in a PIN number. And they offer lower rates than you could get with unregulated debit rates. It gets a bit complex, but if any of you are in that industry, post a question and we can delve into it a little more in the Q&A session. So one of the questions you're probably thinking is, how can I understand what interchange is. Okay, I kind of get a sense of the Durbin Amendment. But how can I get a lot of data from my credit card processor? How can I analyze that data so I can take action to reduce my costs? Let's talk about that. How you can build analytics. Just like with any other process within your organization, if you cannot analyze it and track it, you can't improve upon it. By applying analytics to the data that you currently receive, you can do a lot of things. You can look at, if you have a lot of different merchant IDs, you can look at problems and trends into specific accounts before they become major issues and monitor primary drivers of your cost. And if there was one metric that you should all monitor on a regular basis, it would be effective cost. And you can easily calculate that. Effective cost of card payments is simply all of your fees for card processing, regardless of the name, divided by your net credit/debit card sales. So if your effective cost is 3.0% and you monitor it and you see it going up, that would be a cause for alarm and investigation. And conversely, if you're implementing some initiatives to reduce your cost, you should see that effective cost going down. So let's let me give you a framework, a 5-step framework to build your own in-house analytics. Let's go through these steps. First step is let's identify key metrics. So before you start on this endeavor, kind of think about what are the things that are important to my management, to my organization that I want to measure. One thing might be effective cost. Another metric might be cost by payment tender. What's my effective cost by Visa, MasterCard, Discover, American Express? Effective cost by division or by store. Percentage downgrades. So, I want to optimize my interchange qualification and minimize my downgrade. So I want to kind of track of all of my Visa, MasterCard, Discover sales, how many of those sales are downgrading to suboptimal interchange rates. So that might be a metric. So define that for yourself and have that in the back of your mind as you're starting to build your analytic framework. That's step one. So John, I'm going to turn it over to you for our next question. Polling question.
You got it. So we're going to hop in. This is polling question number 2. As last time, we'll pop it out there. We'll leave it open for about 30 seconds. This is a quick one. What is the effective cost of your card payments, if you know that? Once again, we'll leave this out for a moment. Now I'm going to remind everyone that we encourage you to ask questions as we go so that we can have some good questions for the Q&A segments of today's event, which will be coming up in the next 15 minutes or so. I'll go ahead and leave this out for another 5 seconds. And once again, if you're here expecting CPE credits, you do need to take all the polling questions, but even if you're not, it would be great to see how the statistics end up, and we'll do our best if we have time to turn this around and show folks what the results of these questions are. So I'm going to go ahead and close that out. We'll drop it back to Anand and take it away.
Great, thank you. So we're on step 2. So after you define the key metrics you want to measure, let's gather our data sources. When we're talking about card processing, that's going to be primarily your merchant statement that you get from your processor. Most processors today give you an online access to the reporting, and you can download a lot of this data in to an Excel file, or it can be a comma delimited file. So the kind of data sources we're looking at, if you're getting your card statements from a processor, we're looking at merchant statements, merchant statement or bank statement. Individual transaction detail isn't important. Monthly summary level information is fine. So if in a given month there are 100,000 transactions, you don't need 100,000 records. You don't need transaction level detail. Typically, the data that's available on a merchant statement, on a monthly statement, is sufficient. And then if you have other components that contribute to the cost of your card payment, such as gateway costs, so you want to get that statement, understand what the gateway fees are. So if you have a third party that does your PCI compliance audit, or you have internal resources that invest time ensuring PCI compliance, whether it's hard cost or internal soft costs, you want to get that information so you could include it in your overall analysis. Cost for managing and responding to chargeback, get that. Any sort of exception handling cost that you might have. The idea behind this is, you can calculate your effective cost easily. That's a direct effective cost from a merchant statement. But if one of your goals is to develop some sort of a dashboard where you incorporate your total cost, direct and indirect cost of card acceptance, then some of these other data sources is valuable. So if you want to have an all-in total cost of operating card payments within your organization, then having some of these other payment sources is important. But if it's not, then a simple merchant statement is sufficient. And our step 3 is we want to start organizing this information. Now, like I said, a lot of processors today, they'll give you can go to their reporting site like First Data, you can go to Client Line. With Chase Payment ID, you can go to Resource Online. Elavon, you can go to merchantconnect.com, and you can download most of the reports in Excel or comma delimited files. However, even if you get a PDF file, like email to you, or if that's all you can download, that's okay, because we can work with it as well. You can download a really inexpensive piece of software called PDF to Excel. It costs about $100, and it can allow you to extract data out of a PDF into Excel, so you can use that as well. So when we're organizing our data, you want to think about where we're going to house it. So a lot of us, we use Excel. I mean, Excel is easy, unless you're a big organization where you have tremendous amount of data. You might want to look at a database, some sort of a relational database. But if you, if the amount of records that you're going to have is less than 1 million, Excel is sufficient. If you're using Excel 2007 or later, it has 1 million records in a single worksheet. But keep in mind, this is just our data repository. We're not going to be actually using Excel to analyze the information. This is just a place where we're going to house all the information. Because in one of our steps, we're going to talk about layering a BI tool that links into Excel or into a database that we can use to analyze our information. So if you start organizing your information within Excel, you can kind of think of it as your repository where every month when you get additional information, you can keep appending your file. You can keep adding more and more data. So before you know it, you might have 6 months or years worth of data in a single source. So our next step is when we're organizing the information. So if you're talking about credit card, merchant statements from Visa, MasterCard, Discover, and an American Express statement, even if you're using Excel, you want to have a common layout of all of your data. Here are some of the dimensions and measures that you want to capture for all of the data that you have. So if you're thinking about Excel, you want to basically have columns. You want to have about 15 or so columns with these attributes. If there isn't an attribute, you can manually input a piece of information like what date are we talking about? What's the month for which you have the data? It's January 2013. So put that, copy that down in your date column. What's the data source? Is it a merchant statement? If you have more than one vendor, more than one processor, you can list that here. So if your processor is First Data, it would be First Data. And then if you get a statement from American Express, you can put MX. Your data source or vendor name, what's the payment tender type? Is it a credit card, debit card? A lot of this information like tender type, tender name, the merchant ID, a lot of that information is going to be available on your merchant statement that you download. And then if you want, you can append some demographic information. So if you have more than one merchant ID and you want to do some sort of a roll-up, you can say, you can basically input the roll-up structure that the merchant IDs roll up to if you want to create some sort of a hierarchy. And all this other information is readily available on merchant statements. Once you organize your data, you can segment it. And one of the things that we do is we've created these 6 categories that are fairly easy to tag, to apply to your data set. All the interchange categories, we talked earlier how there's over 700 interchange categories. But if you're a merchant in a very specific industry, let's say e-commerce, on any given month, we're likely going to see less than 50 interchange categories. You might see 30 interchange categories. How do you whittle those 30 down to even a smaller number so you can easily analyze it? So what you could do is basically build a lookup table that say, my 30 interchange categories, they have to belong to one of these 6 buckets. They're either going to be a consumer traditional card, a consumer rewards card, a signature debit card, a commercial card, a downgrade, or a refund. Because that tagging is going to significantly simplify your analysis. So instead of having to think about 30 to 50 interchange categories, now you're only looking at 6 buckets. And for all of your analytic purposes, you're only looking at one, which is downgrade, because that's the one that you can really influence. So once you have a data repository like Excel, and you have a table sort of layout, and you started putting in data into that table format, that becomes your repository, and then you can purchase an inexpensive tool, like a single license for your desktop. Here are some samples of various BI tools that you can go and buy. You can basically tell these tools to look. You can point these tools to your data source, and your data source can be Excel or Microsoft Access or any sort of relational database. And these tools will help you analyze all the information that resides within your data source. And by doing so, by following a process like this, you can start generating, graphs like this. So on the left-hand side, we looked at, all the tender types that we accepted for a given merchant. So we were able to segment it to Visa, MasterCard Credit, Visa, MasterCard Debit, PIN Debit, American Express, and Discover, and look at, total sales, processing fees on a per transaction basis or as a percentage basis, and allows you to do a tremendous amount of comparison. See that PIN Debit is a lot cheaper than even signature debit, and it'd be worthy to do PIN prompting within a retail store. This analysis on the right-hand side is a study that we did where we looked at the effective cost of various tender types. And if you are in a card-not-present environment, if you're an e-commerce site, the cheapest way for you to get paid is ACH. You should really look at implementing ACH acceptance in addition to cards, because ACH is far the best and cheapest way for a lot of merchants to get paid, even if you're a retailer. There was a clever program with one of the grocery stores. When you signed up for a grocery store's loyalty account, a loyalty program, they asked you for your banking information if you wanted to link your banking information, ACH information, to your loyalty account. So when you checked out and you put in your loyalty card number, it would say, would you like to pay with your bank account that's linked to your loyalty card? And if you said yes, that would be an ACH transaction in a retail environment. That was very clever. But if you're an e-commerce site, it's a lot easier to implement online in your checkout page. So I'm going to power through some of these examples here. Here's an example of downgrades, looking at downgrades as a function of sales using analytics. And those groupings that we came up with, we segmented all of our Visa, MasterCard, Discover sales into these 5 buckets. And we wanted to kind of focus on downgrades. In 1 month, we saw downgrades that increased from a typical 3% up to 7%. And we were able to trace it back to a POS outage and to quantify what the impact of that was, and go back to our POS vendor and say, hey, is there an opportunity for us to recover that incremental cost because it was their issue? And then you can also look at the effective cost of each of your card types, each of these 5 groupings. As you would expect, downgrades tend to be the most expensive grouping, and signature debit is the least expensive. Earlier I was mentioning the single most important metric that you want to track is, when you're tracking your card sales, you want to look at your effective cost. How's your effective cost doing over time? And then if you wanted to, you could break that into its 4 subcomponents. The card brands, Visa, MasterCard, Amex, Discover. And sometimes you might find some really fascinating insights. The common wisdom in the marketplace is that American Express is the most expensive tender type. That is true generally. However, there are specific markets where American Express tends to be the cheapest. And so you would never know that, but when you analyze your data, that's kind of a nugget you might find, and that prompted the merchant to really put Amex signage and promote American Express to their customer base. And in one instance, we found that Discover was the most expensive, and that was because of the poor pricing that the merchant had negotiated with Discover. It can lead to a lot of insights. So with that, let's jump into Q&A, and maybe we can look at the results of the polling questions. I also wanted to say, before we get into that, is at the end of the presentation, we have about 6 appendix slides. There are a number of people who registered. They wanted to learn more about how the flow of a credit card transaction, and who are all the parties that play in basically in the value chain of processing a card transaction. So there are a number of slides that talk about it if you want to look at that. And a couple of folks wanted information about mobile POS acceptance, because Square is really popular. And we did some research, and we ranked the top 5 mobile POS providers and gave you some insight on who's the best provider. If that's something you're looking at, look at that slide in the appendix. By far, Square represents the best value if you're looking at a mobile POS solution.
Great stuff, Anand. Fantastic. Just examples in real-world information. I'm actually going to flash through the appendix real quickly just so folks can get a sense for what we've got for you in the appendix. Here's the flow of a card transaction. I'm literally just going to kind of read through these one at a time. So flow of a card transaction. Next one is understanding gateway providers. Actually, that's a 2-slider. Then after that is understanding merchant acquirers. Then understanding card networks. And finally, the mobile point-of-sale landscape, which you just mentioned at a little more length. So this is all available when you download the presentation. The whole presentation is already available at proformative.com /resources, and you can just grab it at any time for free, of course. That's how we do things around here. Okay, so why don't we take a quick look at a couple of polling questions, have it on comments on those, and then we'll jump into the Q&A. And by the way, we do have one more polling question, which will be at the end of the event, so hang on for that. But let's take a quick look at the 2 that came already. First one, what is the biggest challenge when it comes to managing your card payments? On costs, I guess that's not too surprising, but what do you think about this series of results?
Absolutely. This kind of tracks with what we have seen in the past. One thing that we see rising is understanding and leveraging alternative payments, because there's a lot of talk in the marketplace about PayPal, not only for e-commerce, but PayPal is coming to the retail space too. Cost is always a big concern, and the complexity causes anxiety with reporting. So I can see cost and reporting as being the top 2. As the industry gets more complex, so does the reporting, and it's really difficult to decipher all that data. So I could totally see those being the top 2.
Gotcha. PCI security, interesting. A few years ago, that might have been towards the top. Now it's at the bottom, at least, of this list. Have you seen people just gain more comfort with their own and the all of the various channels security?
Absolutely. I think we've had a couple of years where we've seen a lot of high-profile breaches, and that's given the industry a lot of heartburn and has caused them to really take a lot of action, whether it's acquirers working with their merchants to make sure they're PCI compliant, implementing fines if they're not, or offering basically carrots and sticks to make sure that they minimize any sort of vulnerability. Another big product that's come out in the marketplace for reoccurring billers is tokenization and encryption. So if you're an organization that stores card data because you're going to bill that customer on a monthly, quarterly, annual basis, a lot of organizations used to keep that card data in-house, but there's really, really no reason for most companies to do that. Most companies find by using a product called tokenization, which a lot of companies offer, they can store that information, their card data, off-site, outside of their firewalls to an industry vendor who's PCI compliant to minimize their PCI exposure. So there are a lot of new products and solutions that cause PCI concerns to go down as well.
So people are effectively outsourcing their PCI headache to what are now some established players.
Absolutely.
Okay, great. Poll number 2, just taking a quick look at what folks' effective costs are. Less than 2%. So, I mean, does this look like a relatively normal spread that you would expect? And is 2%, you know, on sort of a world-class benchmark, or how would you describe these brackets here, Anand?
Yeah. So this is typical to like a bell curve you see. So you see a few on either end of the spectrum and majority in the middle. And effective cost is really a function of the industry that you're in. So it's although this is somewhat indicative, it's not fair because of all the participants on this call, you might be very representative of multiple industries, from retail to e-commerce to B2B to healthcare. So I would tell you, like, retail would have the lowest effective cost. So anybody that's like less than 2, they're more likely than not to be in the retail space. And the higher effective cost, they're more likely to be in the B2B space. But if you're outside the 2 to 3%, it's worthy for you to investigate your effective cost further and see, you know, what are the drivers that are causing you to be in, you know, these 3rd and 4th brackets.
Mm-hmm. Great. Okay, let's go ahead and jump into questions. We've got a bunch of questions, but feel free to keep them coming. So we got a couple questions about transaction downgrades. Can you talk more about that? How do they happen, and why, and what can be done about that?
Sure. So let me define downgrades again. A downgrade is when you process a transaction suboptimally. And let me illustrate that by a few examples. So if you're in a card not present environment, you take a card number either, you know, through an IVR, the phone, or the web, or via mail. When you process a Visa transaction in a card not present environment, you have to put the customer's billing zip code called AVS, right? When you do AVS, you get a better interchange rate. If you don't do AVS, you end up paying about 40 basis points more. So 40 basis points is 0.40% for Visa cards. So you want to implement, because this rule is specific for Visa, it's smart to just implement it wholesale for all of your card not present transactions, whether it's Visa, MasterCard, Discover, or American Express. A lot of people ask about CVV. CVV is the 3-digit number on the back of a Visa, MasterCard, Discover card, or the 4-digit number at the front of an Amex card. That is an extra level of security that helps you with chargebacks and helps you with fraud, but it has no impact on interchange rates. So if you're in a card not present environment, always do AVS, which helps you get a better rate, and also do CVV, which helps you reduce fraud and fight chargebacks. Some other examples of downgrades are if you take business cards. I mean, business cards are prevalent. You don't have to be a B2B merchant. You could be a retailer or an e-commerce site, and a small business, you know, a consumer decides to pay you with their small business card. Because it's tagged as a business card, you have to send level 2, which is sales tax information, to get the best rate. If you don't, you pay a slightly higher rate. If you are in a B2B environment and you take purchasing cards, you have to send level 3 information, which is line item detail. If you don't, you end up paying a much higher rate. So depending on the kind of industry you're in, you might experience different kinds of downgrades. So those are 2 examples. Some other examples are you always want to authorize and settle for the same amount unless you are in a tipping industry like a restaurant or bars or beauty parlors. But let's say you're an e-commerce site. If you authorize a card for $100 and the consumer orders 2 pieces of, 2 items like you do from Amazon, and Amazon ships out one item first because it's available, the first item was $55. What you want to do is there are many strategies, but one strategy could be reverse out the first authorization for $55, get a second authorization reverse out the first authorization for $100, and get a new second authorization for $55, and get a new second authorization for $100, 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 and get a new second authorization for and settle for 55, because that customer is going to have two card transactions, one for 55, one for 45, because you're doing a split shipment. That's one way to do it. There are many, many different ways to address that problem, to make sure that the authorization and the settlement amount match. And then you also want to make sure that you authorize and settle within the time frames for your given environment. So retailers, for example, have 24 hours to authorize and settle. You want to make sure that your POS system is auto-configured to do that every day.
Great, thank you. How do you ensure that you are receiving interchange pass-through pricing?
A couple of ways. You can look at your merchant statement. If you see interchange detail, interchange names, then likely you are. And you can also ask your credit card processor, am I on interchange pass-through pricing? Or you can ask someone like us. You can ask an industry expert. They could readily look at your data and let you know.
Okay. Can you talk more about gateway costs?
Sure. So gateways are often used by e-commerce sites. Gateways basically link a shopping cart to a credit card processor. So they can be thought of like the cash register in a retail store. They're kind of like the cash register for an e-commerce site. That is one function of a gateway. Another function of a gateway is connecting an application. It can be a retail point-of-sale application to a credit card processor because the application is not certified directly to the credit card processor. So there are a couple of functions, but in either case, most gateways, the way they work is they charge a per transaction fee. And one of the earlier slides, we listed the considerations that go into selecting an appropriate gateway, and we ranked some of the largest gateways in the U.S. So their business model is typically similar. They're going to charge you a per transaction fee, and that per transaction fee is going to be dependent upon the services that are wrapped around the gateway. It could be a simple, they could provide a simple service where they're simply routing your transaction from your shopping cart to the processor, or they could bundle in additional services too, like tokenization, like fraud protection. So it depends on what services you wrap around within your gateway, with your gateway provider, that determines your per transaction fee.
Okay. Next up, are debit cards always cheaper than credit cards from the corporations or from the card receiver's perspective?
As a rule of thumb, yes, with one exception if you are in a small ticket environment and your average ticket is less than $10. With that exception, as a rule of thumb, yes, debit cards are always cheaper than credit cards.
Gotcha. Next question, how do smaller firms mitigate the impact of the Durbin Amendment, which might be raising their costs, without passing along to customers? Is there anything you can do within sort of the mechanisms and levers you have in place in managing card costs?
If you're a small merchant, the way this industry, the card payments industry is set up is, unfortunately, small merchants end up paying the highest rates to their card processors because there are a lot of monthly fees and quarterly and annual fees that are tacked on that make your effective cost sometimes go through the roof. It could be north of 7, 8, 9% of your sales, which is really high. Something you may want to do is you look at some of the alternative providers. If you're a small business, you should be really looking at PayPal. I don't get paid anything from PayPal, but I like them for small businesses because they have very simple and competitive pricing. And if you're in a retail environment and you're a small business, look at Square, because you could leverage your cash register with an iPhone or an iPad and get very clean, simple pricing of 2.70% without any monthly fees.
Great. Thank you. And with that, we're actually getting towards the end. We've got a couple bits of housekeeping and the final polling question. So There are a few questions we didn't get to. Anand, would you mind if we work with you to get those at least posted out on Proformative where folks can come back and check it out and have other people comment as well?
Absolutely. We can move this discussion onto your forum.
Wonderful. That would be great. So if you have any last-minute questions, even though we're not going to get to them right now, we'll still work with Anand to get them answered for you. So I got a little bit of a housekeeping, but before we even get to that, Anand, thanks so much for your time and insight this morning. Really fascinating and great information, well presented. Thanks for helping us out on that front.
Thank you, John, and thank you for the Proformative community. This is an excellent forum to learn and share information.
Wonderful. And for the record, we did not pay you for that endorsement. Okay, let's go ahead and hop into a couple other pieces of housekeeping before we get to the end of today's hour. So you will be prompted to take a short survey. What we're going to do is one more quick slide, and then we'll do the final polling question. And then we'll shut down the webinar, and you'll be presented immediately with a short survey, literally 60 seconds or less, just a bunch of clicks with the mouse. During that survey, if you want to be connected to Anand, we'd be more than happy to make that connection. Just indicate that, and we'll help you with that. Of course, we're going to continue the conversation at Proformative, so come and join us there. And if you have any questions about CPE credit, please contact Chris Brower. You can see her contact information below. One other thing I want to point out, we have a wonderful tech conference. A lot of what we were talking about today was technology, BI systems, and a bunch of other tech. And we've got a wonderful, broad-based finance, accounting, and treasury tech conference coming up on March 20th in San Francisco. Of course, it's free. Of course, it's only open to finance, accounting, and treasury. So you won't be assailed by people trying to sell you stuff. This is an amazing place to learn about a variety of finance, accounting, and treasury technology, all under one roof, one day. We've got a whole pile of CFOs and other folks, similar finance, accounting, and treasury leaders ready to talk, and it's going to be wonderful. So also in your survey, if you'd like us to register you for this, indicate that there. And now, with our last minute, we are going to launch our final polling question here, which I'll put out right now. And this question is, what is the biggest hurdle in implementing payment analytics within your organization? As always, I'll go ahead and keep this open for about 30 seconds. Whether or not you're here for CPE credit, we'd appreciate you taking the 5 seconds here and answering this question. It's always interesting to see where folks sit, and this information is very useful for us and our speakers to understand the challenges that our users are having on a day-to-day basis. So I'll leave that open for 5 more seconds. I'm going to go ahead and shut that down now. Thanks to everyone who voted there. And at this point, I'm going to shut down the webinar. Thanks, everyone, for being with us this morning, from Anand Goyal of Optimized Payments Consulting, and, of course, all the busy folks who joined us today. We really appreciate your time. We hope to see you again online at Proformative.com or at another event. And that's it. Here comes your post-event survey. Thanks, folks.